Everyone always blames Japan's lost decades on the real estate bubble. Like, that's the whole story we hear, right?
Oh, absolutely. The classic narrative. The property bubble pops and the whole economy just flatlines.
Yeah, but that is a massive lie.
Hmm.
Or, well, at least it's totally missing the real villain.
Yeah.
Today, we're going to completely rip up that script.
It's going to be a fun one. We're looking at something that started way before the bubble burst.
Exactly. I want to throw a crazy data point at you right out of the gate. Think about the year 1991.
Right before the big crash really set in.
Right. In that year, Japanese corporate cash accounts were the highest in the entire developed world. I mean, they held almost double the cash of anyone else.
Just sitting there.
Just sitting there. Nearly 20% of their total asset base was cold, hard cash.
Which is just a staggering amount of money doing absolutely nothing.
It's insane. And for years, people thought, oh, this is just Japanese financial discipline, like they're just super cautious.
Right, the whole saving for a rainy day myth.
But it wasn't for safety at all. Okay, let's unpack this. We are doing a deep dive into a landmark piece of financial detective work today.
Yeah, this is a massive study from two Georgetown University researchers, Lee Pinkowitz and Rohan Williamson.
And they basically tore the nice, polite mask off the Japanese banking system, right?
Totally. They looked at a literal mountain of data from the US, Germany, and Japan, and what they found is it's mind-blowing.
What's fascinating here is that they proved this wasn't a cultural quirk.
Yes.
It was a perfectly legal, meticulously designed robbery.
A total heist. And the best heists, they don't happen with guns, they happen with bank mandates and spreadsheets.
Exactly. So to really understand who choked the life out of Japan's economic miracle, we have to look at the great myth of that era.
The famous main bank system.
Right. So in the U.S., big companies are owned by like millions of scattered investors, right? You, me, mutual funds.
Which creates a huge babysitting problem.
The babysitting problem. I love that term. Because basically no single owner has enough power to watch the CEO.
Right. So the executives can just waste money, buy corporate jets, overpay themselves, whatever.
Because no one is watching the checking account. But the traditional theory said Japan fixed this. They had the ultimate guardian angel.
The main bank, a giant all-seeing bank that sat on the board, held the debt, and watched the company's every single move.
So on paper, that sounds amazing. Like no money gets wasted because the bank slaps down any bad ideas.
That was the theory. And logically, if you have an all-seeing guardian angel promising to bail you out...
You shouldn't need a massive emergency fund.
Right.
Like if I have a super rich uncle monitoring my spending and promising to pay my rent if I lose my job, I don't need to stuff cash under my mattress.
Exactly. You should hold way less cash than a messy U.S. company. But the Georgetown data showed the exact opposite.
This is the first big face-slapping moment. The data completely broke the myth.
Wow.
Japanese companies were hoarding absolute mountains of cash.
Right. They weren't traveling light at all. The supposed guardian angel was somehow linked to them stockpiling cash like doomsday preppers.
Which is just wild. So let's count the actual size of this hoard. Because the numbers they're just absurd.
They really are. And the researchers were super careful here. They stripped away all the complicated cross-investments.
Yeah, none of that stockholding stuff, just pure liquid cash.
Right. And on average, 18.52% of a Japanese company's total worth was pure cash.
Almost a fifth of their entire empire. Just sitting in a bank account.
And when you compare apples to apples, looking at the median firm, it's even crazier.
How crazy?
The median Japanese firm held 2.5 times more cash than the median firm in the U.S. or Germany.
2.5 times.
Yeah.
I mean, imagine taking a fifth of your life savings and just putting it in a zero-interest checking account for decades.
It does nothing. It doesn't build factories. It doesn't hire workers.
It's totally dead money. So this clearly wasn't a rainy day fund. This was like flood preparation for a storm that wasn't coming.
Exactly. And the mystery gets even weirder when you look at which companies were hoarding the most.
Oh, right. The paradox of scale. This completely defies all basic laws of business.
It really does. Because in normal economies, there's a basic rule. The bigger the beast, the hungrier it gets, but the less it needs to store.
Like if you're a tiny tech startup, you keep a ton of cash because you're fragile.
Right.
One bad month and you're dead.
Precisely. But massive corporations, they hold proportionately way less cash.
Because they have super stable incomes. And they can just borrow money overnight if they need it.
Right. But in Japan, the rules of gravity were completely reversed.
Completely upside down.
Yeah.
The massive titans of industry, the giant automakers, They actually hoarded more cash proportionately.
Which makes zero sense. If we connect this to the bigger picture, it proves one thing absolutely.
The cash wasn't for operational survival.
Exactly. A global conglomerate doesn't need 20% of its balance sheet in cash just to make payroll. It was a symptom of something unnatural.
Okay, so if they aren't using the money to survive and they aren't using it to build things, what should they be doing with it?
Well, what do normal companies do when they have too much cash? They give it back to the owners.
The shareholders, they pay dividends.
Right. But Japanese companies were holding a king's ransom and acting like absolute paupers to their investors.
This is where the Iron Curtain of dividends comes in. They were so cheap.
Incredibly cheap. And this is why comparing them to Germany was so brilliant by the researchers.
Yeah, because Germany also had a bank-heavy system, right? So you'd think they would act the same.
Exactly. But German companies operating in a similar environment paid out almost 80 times more in dividends.
Wait, 80 times? 80.
80 times more.
That is genuinely infuriating. If I own stock and the company has billions in cash, but they refuse to give me a dime while a German company is showering its investors.
It tells you exactly who is actually in charge.
Right. So what does this all mean? Who is pulling the strings if not the owners?
Well, before we officially point the finger at the banks, we have to dismantle the last big excuse from the traditionalists.
The volatility enigma. The panic room excuse.
Right. The defenders of the system said, hey, maybe Japanese companies hold cash because their income is wildly unpredictable.
Like they live in a riskier neighborhood, so they need a bigger fence.
Exactly. But the Georgetown researchers tested this mathematically.
And what did they find? Because I feel another face slap coming.
U.S. corporate income was 4 times more volatile, 4 times more chaotic than Japanese income.
Wow. So U.S. companies lived on a total financial roller coaster, but they traveled light.
Yep. And Japanese companies lived on a slow, predictable, completely smooth train track.
Yet they packed survival gear for an apocalypse. The safety excuse is totally dead.
Dead on arrival.
Yeah.
So now we have to look at the trap itself. The famous corporate families, the Keiretsu.
Right. Everyone always praises these tight-knit Japanese corporate families. A bank, a steel maker, a shipping line, all protecting each other.
And the data does show a little nuance here. Companies inside these families did hold slightly less cash than outsiders.
So they had a safety net.
They did, but this wasn't a free lunch. It was a velvet handcuff.
Velvet handcuffs. I love that. Because stepping into that safety net meant handing over your absolute freedom, didn't it?
It was the beginning of a deep, inescapable binding to the family's central bank.
Okay, here's where it gets really interesting. Let's look at the absolute control of the 90% caller.
Yeah, let's look at who these companies actually owed money to.
In a free market, you borrow from everyone. You issue public bonds, you go to 5 different banks, you chop around.
That's what gives a company leverage. But in Japan, the government regulations basically banned public corporate bonds.
So they were trapped.
Totally trapped. For the average Japanese company, almost 90% of their debt came from banks.
And that's just the average. The median company was what, 100%?
A terrifying 100%. One single master.
Imagine having a single grocery store in your town. By law, you have to buy food there.
Right.
But the grocery store manager is also your boss at work and your landlord. You have zero leverage.
If they tell you to jump, you jump. Are you a business partner in that scenario, or are you a hostage?
You are 100% a hostage. And this brings us to the grand reveal. The expropriation hypothesis lands.
This is the core thesis. The cash wasn't an accident. It was a massive hidden wealth conveyor belt.
The researchers finally cracked the code. The banks had an absolute monopoly. And what do monopolies do?
They squeeze hard. The banks forced the companies to deposit mountains of cash back into the bank.
So the bank was legally extracting the lifeblood out of the industrial sector just to feed itself.
Exactly. The banks weren't protecting the companies. They were using the companies as their own personal ATM.
Okay, we need to do the ruthless math on this.
Where?
The greedy arithmetic of 5% versus 100%.
This is where it gets really diabolical. Why did the banks hate dividends so much?
Right, because if I'm a bank and I own stock in the company, shouldn't I want a dividend?
You would, except Japanese law stated a bank could only own a maximum of 5% of a company's stock.
Anti-monopoly laws. Okay, so let's walk through this. Say I'm an auto company, and I want to pay out $1 million in dividends.
The bank, with its 5% cap, gets a pathetic $50,000.
Which is literally a rounding error for a mega bank.
Exactly. But What if the bank uses its power to veto that dividend?
And forces me to keep that $1 million as a cash deposit inside their bank.
Bingo. Now the bank has 100% of that $1 million sitting in its vault.
And what do banks do with deposits? They don't just sit on them.
No, they turn around and loan that $1 million out to someone else for massive profit.
Oh my God. It is a perfectly legal, mathematically flawless exploit. They hijacked 100% of the value of money they only had a 5% claim to.
It's brilliant, but incredibly toxic to the real economy.
It's an absolute robbery. But wait, if I'm forced to keep billions in a bank account, I should at least get a really good interest rate, right?
That's what would happen in a free market. But remember the monopoly.
The invisible tax. Don't tell me they paid them nothing.
Because the banks had total control, they paid artificially, laughably low interest rates on these massive corporate deposits.
So they trap your money, use it to make themselves rich, and pay you absolute pennies.
It was a devastating invisible tax. The banks were getting free ammunition to run their empires, while the actual companies starved.
This is just enraging. But why trap the cash specifically? Like, why not just charge higher interest on the initial loans?
That brings us to the selfish meat shields.
Meat shields.
Okay.
Explain this.
In the Japanese system, the main bank was terrified of one thing above all else: a client company going bankrupt.
Because it would make the bank look terrible, right? Like, you are monitoring them. How did they fail?
Exactly. The bank would lose immense face, suffer massive reputation damage, and be expected to cover the losses.
So, to protect themselves from looking bad,
They forced the companies to carry impossibly heavy cash reserves. They sacrificed the company's speed entirely just to protect the bank's downside.
they made the companies wear lead boots just so the coach wouldn't get embarrassed.
This raises an important question. If a system prioritizes the middleman's reputation over the creator's growth, how long can it last?
Not forever, which is why the Iron Curtain eventually cracks.
Right. No empire lasts forever. Even the tightest monopolies face the light of day.
So we shift timelines. The 70s were the strong bank era. But moving into the 90s, the government started deregulating.
They finally let companies issue public bonds. The iron grip started to rust.
The prisoners are suddenly handed the keys to their own cells. What do? Do they stay with their guardian angels?
The defenders of the banks swore they would stay. They said, oh, it's a cultural preference.
But we have the ironclad proof of fading power. The cash flow cliff.
The ultimate proof that this was a hostage situation all along.
Right, because if they wanted to hold the cash, deregulation wouldn't change a thing.
But the data tells a dramatic story. As soon as the banks lost their absolute power, corporate cash levels plummeted.
They fell right off a cliff, moving rapidly toward normal U.S. levels.
The moment the gun was removed from their heads, Japanese companies stopped hoarding cash.
And the researchers proved this with an incredibly cool test, right? The taste of freedom test.
Yes, the convertible bond test. The ultimate paradox.
So they tracked the exact year a Japanese company issued its very first public bond, getting money from the public instead of the bank.
Now, mechanically, issuing a bond means a massive inflow of new cash to the company.
So your bank account should go up, obviously.
But the data shows that in that exact year, the company's overall cash hoard shrank.
Wait, getting millions in new money made their bank account smaller?
Because they finally had the freedom to spend their own money.
Oh, they broke the monopoly, so they didn't have to follow the forced hoarding rules anymore.
Exactly. They took the new bond money and their old crapped cash and spent it on growth, or paid off the bank.
Freedom meant leaner, faster companies. They were finally off the leash.
But of course, the banking defenders tried to create an alibi. They couldn't just admit it was extortion.
Right, they came up with the compensating balance excuse, dismantling the alibi.
Some traditionalists argued this was just a technical quirk. They said interest rates were capped by the government.
So to get around the cap and charge a fair market rate, banks forced companies to keep a percentage of the loan in a zero-interest account.
Right. A compensating balance. They claimed it wasn't a robbery, just a workaround for a cheap loan.
But the Georgetown researchers completely blew this up, didn't they?
Totally. Because if the banks were actually offering a good, cheap service, companies would have stayed with them even after deregulation.
Because bank loans are supposed to be cheaper than public bonds. But did they stay?
No. When the markets opened, the companies fled in terror.
The proportion of bank debt dropped aggressively, right? From like 94% down to 74%.
You don't flee a benevolent partner, you flee a warden. The squeeze was real.
But the really sad part is, the scars lasted. The persistence of zombie cash.
Right. Even though cash levels dropped, Japanese companies held on to excess cash much longer than the US or Germany.
It's like financial PTSD. Why couldn't they shake it off?
Because the banks had spent decades ensuring there were no active, demanding shareholders to scream, "Give us our money."
So when the bank left, there was a power vacuum. No one was left to optimize the system.
They let the zombie cash rot until the whole system broke in the 90s.
Which brings us to the ultimate price of the model. Two paths diverged, Germany and Japan.
Let's look back at Germany. They also used a bank-heavy system. But what was their secret?
They had large active shareholders sitting at the table, right? Labor unions, founding families, pushing back against the banks.
Exactly. Co-determination. The result was normal cash levels and massive dividends, a balanced ecosystem.
But Japan let the banks become the undisputed kings. And the cost was a hollowed-out corporate sector bled dry by its own protectors.
It wasn't a cultural quirk. It was a devastating structural flaw.
Think about the companies that built the global electronics and auto industries. They were secretly running with weighted boots on the whole time.
It really changes how you view economic history.
It totally does. And it brings us to the ultimate question of historical cycles. Let's bring this right to your doorstep today.
Because history rarely stays in the past.
We've just watched how an entire economy suffocated because financial middlemen became more powerful than the companies actually making things.
The bank became a vampire, treating real industry as nothing more than a deposit channel.
So look around at today's world. Look at how massive our financial sector has become.
So private equity firms, the mega banks.
Are we watching the same tragedy repeat itself? When the people moving the money have absolute power over the people making the goods, economic vitality dies.
It's a slow drain.
Think about who holds the power in the companies you invest in or the company you work for. Are they building for the future?
Or are they just hoarding cash for the warden?
Exactly. Something to think about the next time you look at your portfolio.
Thanks for joining us on this deep dive.
See you next time.